Welcome, curious minds. Today, we're dissecting Skywest Inc., ticker symbol SKYW.
That's right.
And on the surface, well, the numbers really seem to scream success, don't they? Especially after an incredible multi-year run for the stock.
They really do. The performance has been quite something.
But we've got a rich stack of sources here. I mean, everything from detailed financial metrics to some pretty fascinating insider trading data and comprehensive analyst reports, too.
A really good mix of quantitative and qualitative stuff.
Exactly.
At its core, Skywest Inc. is a holding company. It was established way back in 1972, actually, and it's headquartered out in St. George, Utah.
Okay.
Its primary business, which it runs through its subsidiaries, is providing scheduled passenger services across a really wide geographic area. We're talking the United States, Canada, Mexico, and the Caribbean.
It's a pretty extensive reach.
Definitely. They're not just a regional airline. They're a really significant and quite entrenched player in the whole North American air travel ecosystem.
Okay, so they're not operating under their own brand name that you might typically see on a big jet at, say, JFK or LAX, are they? That feels like a crucial distinction in understanding their strategy.
Precisely. That's a key point. What's truly fascinating here is their specific niche and their business model, which is fundamentally different from a mainline carrier like, United or Delta themselves. Well, Skywest generally operates regional flights. They strategically use their smaller, more fuel-efficient, and crucially, lower-cost aircraft.
Right, those smaller jets you often connect on.
Exactly. And instead of direct consumer branding, for the most part, they forge these long-term partnerships with the larger airlines.
Ah, okay.
So they'll operate flights under those major carriers' brands, think United Express, Delta Connection, American Eagle, Alaska Airlines flights operated by Skywest.
Right, you see that operate by line often.
Yes, and this relationship is often structured as a fixed fee or a cost-plus contract. Essentially, Skywest flies the planes, provides the crews, manages the operations.
While the big airline handles the branding and ticketing.
Exactly. Skywest leverages the larger airline's ground support, their marketing muscle, booking systems, airport infrastructure, and in return, they get a predetermined fee or reimbursement for their costs, plus a fixed margin.
So it shields them a bit from ticket price fluctuations.
It does. It allows the larger airlines to extend their route networks into smaller markets or maybe increase frequency on certain routes without having to deploy their larger, more expensive mainline aircraft or absorb the full operational risks of that regional flying.
Makes sense.
Meanwhile, Skywest gets to focus purely on efficient regional operations, maximizing the utilization of their specific fleet under these often lower-risk contracts. It's a symbiotic relationship, really.
Yeah, that model makes perfect sense, especially in an industry where margins can be, well, razor thin sometimes. It feels like a smart way for them to carve out a profitable and relatively stable segment of the market.
It reduces their direct exposure to things like fuel price volatility and those intense ticket price wars you see among the major carriers.
Right. And how do they structure these operations internally? Do they have distinct segments they report on? Does that give us more insight?
They do, yeah, and it does shed some light on their strategic asset management, actually. The company primarily operates through two reportable segments.
Okay.
The first, and by far the largest, is Skywest Airlines and SWC. Now, SWC here refers to Skywest Charter, their on-demand charter operation, which kind of complements their scheduled service.
Got it.
So this segment, it encompasses the bulk of their revenue and operating expenses. It represents their core flight operations, the actual flying of passengers for their big airline partners, and their own charter services.
And the second segment?
The second segment is Skywest Leasing. Now, this segment generates revenue specifically from the ownership costs earned under those applicable cost and fixed fee flying contracts.
So it's about the planes themselves.
Exactly. It highlights a crucial asset leasing component to their business. It indicates that they might not just operate aircraft, but also derive significant revenue from the ownership costs associated with those aircraft under specific contractual arrangements.
So it adds another layer, maybe more predictable revenue.
It adds a layer of sophisticated asset management and financing to their overall business model, yeah. This dual structure provides both operational efficiency and asset utilization leverage.
So it's not just about flying planes. It's also about how they manage their aircraft assets financially, extracting value from owning that fleet. That gives them multiple, maybe more predictable streams of revenue compared to the volatile passenger revenue of mainline carriers.
That's a good way to put it.
And to give our listeners a sense of their footprint, how large is Skywest in terms of its workforce and just general operational scale?
Well, to give you a sense of their scale, the company employs approximately 14,610 individuals.
Wow, that's substantial.
It is. That's a substantial workforce. And it really underscores their significant operational footprint across North America and the Caribbean. They're managing hundreds of regional jets and literally thousands of daily flights.
So this isn't some small niche player. It's a major logistical operation.
Absolutely.
Okay, now that we know who they are and how they operate, let's look at their presence in the market. What's the current state of SKYW's stock and its overall valuation? As of our sources, what are we seeing? And maybe what are the deeper implications of these numbers?
Okay, market snapshot. The stock's last close as of August 15th, 2025, was $116.50.
Okay.
On that particular day, it saw just a slight dip, $0.17, or 0.15%. So a relatively quiet day at that specific snapshot.
Right, just one day.
But it's really the broader valuation metrics that truly tell the story for a company like this, especially in this industry.
Agreed. And for an asset-heavy, contract-based business like SkyWest, the distinction between, say, market capitalization and enterprise value feels absolutely critical. What do those two figures reveal here?
Yeah, this is a prime example where just looking at one metric can be misleading without context. SKYW's market capitalization stands at $4.70 billion.
Okay, value of all shares.
Right, represents the total value of all its outstanding shares. Essentially, it would cost you to buy every share on the open market. However, its enterprise value is notably higher at $6.55 billion.
That's a big difference.
Yeah.
Nearly $2 billion.
It is. And the difference here is crucial, especially in capital-intensive industries like airlines. Enterprise value, or EV, it accounts for both the equity value, the market cap, and the company's total debt, but then it subtracts any cash it holds.
So it's a more holistic view of the total cost to acquire.
Exactly. It provides a more holistic picture of the company's true economic value because it reflects the theoretical cost to acquire the entire business, which includes taking on its debt and getting its cash.
Which for an airline is key, given the cost of planes.
Absolutely. For an airline, which often carries significant debt due to massive aircraft purchases and leases, enterprise value almost always provides more accurate reflection of its total value than market cap alone. The higher EV here clearly suggests that debt plays a substantial role in their capital structure.
Which is pretty typical for the industry. Right?
Very typical, yes.
Okay, that's a great distinction for our listeners to really internalize. It's not just about the stock price, it's the full financial picture, including leverage. What about the shares themselves? How many are out there and how many are actively traded? The float.
Right, the share structure. So SkyWest has 40.37 million shares outstanding in total.
Okay.
Of those, the shares float, that's the shares readily available for public trading, amount to 39.51 million.
So most are available for trading.
Pretty much. The small difference there is typically restricted shares, maybe held by insiders or under vesting schedules, not on the open market. The float itself is important for understanding liquidity.
Easier to buy and sell without moving the price too much.
Right.
Yeah.
Generally, yes. A large float means a stock is usually easier to trade without dramatically impacting its price, which is obviously key for big institutional investors.
Right. Now, here's where it gets really interesting, I think. Let's talk about the stock's historical performance. We often hear about market fluctuations, but SkyWest has seen some truly significant movement, especially over longer periods. What do the numbers tell us about its trajectory, and what can we maybe infer from that?
Indeed, the performance figures are quite compelling. They speak to a remarkable resurgence, really. In the short term, the stock has seen strong gains recently, 5.13% in the last week alone.
Pretty good for a week.
Yeah. 1.74% in the last month, and an impressive 14.54% over the last quarter. So, solid recent momentum.
And widening the lens a bit. Year to date, past year?
Looking at a broader scope, it's up 16.35% year to date and a substantial 59.65% over the past year.
Wow. Nearly 60% in a year is very strong.
It is. These are robust, short to medium term gains that suggest strong recent operational performance and, well, growing investor confidence.
Those are impressive. But the really eye-popping numbers often come from the long-term view, don't they? What's the trajectory over several years, and what might that tell us about SkyWest's operational strengths or maybe market resilience?
You're absolutely right. The long-term performance is truly striking. Get this, an astounding 391.56% gain over the last 3 years.
391% in 3 years.
And 267.97% over 5 years. And wait for it, a staggering 581.69% over the past decade.
Okay, that's phenomenal. Over 580% in 10 years.
It really is. These significant multi-year returns, they aren't just a simple recovery from, say, the pandemic downturn or other industry slumps. They seem to underscore SkyWest's mastery of that regional airline model we talked about.
So it suggests something more fundamental.
I think so. It suggests their ability to capture value, not just when the whole industry is rising, but maybe through disciplined execution, even when larger carriers face turbulence. It hints at a unique operational advantage. Maybe the stability of their contracts allows them to perform well regardless of broader economic shifts.
That's a powerful indicator.
Oh.
And where does it stand relative to its recent peaks and troughs?
Good question. For context, the 52-week high was $135.57. It's currently trading, as of that snapshot, about 14% below that peak.
Okay, so off its highs a bit.
But it's also 61.6% above its 52-week low of $72.09. So it's had a massive run, pulled back a little, but still way up from its lows over the past year.
Those long-term numbers are genuinely remarkable. They speak to a company that's been consistently delivering significant shareholder value over time, indicating some deep underlying strengths. But with such impressive gains, how volatile is this stock?
Good question. High returns often come with high volatility.
Right. What should our listener know about its price swings and the associated risk?
Volatility is definitely a key factor here, especially for a stock that's seen such strong performance. SKYW has a beta of 1.92.
Okay, what does that mean in simple terms?
A beta over 1 means it's more volatile than the overall market. A beta of 1.92 means the stock is significantly more volatile. If the broader market moves 1%, SKYW, on average, tends to move 1.92% in the same direction.
So it amplifies market movements.
Exactly. It amplifies both gains and losses. So for you, the learner, this indicates higher risk, certainly, but also potentially higher reward. You should just expect larger and more rapid swings, both up and down, compared to an average stock.
Good to know. Is there a way to get a sense of its typical daily fluctuation?
Yeah, the average true range, or ATR, helps with that. The ATR over 14 days is 3.55.
Meaning?
It tells you that on an average day, you can expect the stock price to move about $3.55 from its high point to its low point during the trading day. It gives you a tangible measure of its daily trading range, its typical daily wiggle, if you like.
Okay, so a high beta stock, it can amplify market movements. Definitely something for a potential investor to be aware of. Now, what about who actually owns these shares? Is it mostly individual investors, or are large institutions heavily involved? And what does that tell us?
The ownership structure is quite telling, actually. A very high percentage, 91.16% of the shares, are owned by institutions.
91%, that's huge.
It is very high. This often suggests a certain level of confidence from large investment funds, pension funds, other professional money managers. It can imply stability because these are often long-term holders.
But it also means big trades can have a big impact.
That's the flip side. It also means that large block trades by these institutions can have a significant, sometimes sudden impact on the stock price, just due to their sheer volume.
And what about insiders? The management, the directors?
In contrast, only 2.15% is owned by insiders.
Relatively small.
Yes, quite small. And that relatively small percentage, when you couple it with such high institutional ownership, it points to a company largely held by professional money managers rather than being under strong founder or family control.
So its valuation is heavily influenced by what the big funds think.
Pretty much. Its trajectory is heavily influenced by the analytical rigor and investment decisions of these major funds.
Okay, that's a clear picture of who's holding the reins, or at least most of the shares. Now let's get into the real heart of the matter. The actual financial numbers. How profitable is SkyWest, and how is it valued by the market based on those profits? Let's dive into the core figures.
Right, the nitty-gritty. We have a wealth of data here that honestly paints a pretty robust picture. Let's start with their profitability over the trailing 12 months, the TTM.
Okay.
SKYW reported an net income of $407.91 million.
Almost $500 million in profit.
Yeah. And their sales or revenue over the same period were $3.84 billion. So substantial top line and bottom line figures.
Solid numbers. But to really understand their efficiency, especially for an airline, We need to look at the margins, right? How much do they keep?
Exactly. Margins tell us how much they keep from each dollar of revenue. And for an airline, they're especially indicative of strong management given the cost structure. What do SkyWest's margins look like?
Yeah, how do they reflect that unique regional contract model?
Okay, these are crucial for understanding their operational efficiency. Their gross margin is 23.71%.
What does that cover?
This shows the profit left after subtracting the cost of goods sold from sales. For an airline operating primarily on those fixed fee or cost-plus contracts, this relates directly to the efficiency of their flight operations, covering direct costs like fuel, crew salaries, maintenance for the flights.
So a healthy gross margin suggests they manage those direct costs well.
Precisely. It's a hallmark of their model's potential efficiency. Now, moving down the income statement, their operating margin is 15.23%.
And that includes more overhead.
Right. This reflects profit from the company's core operations after deducting all operating expenses, including administrative, sales, general overhead. A healthy operating margin in the airline industry, particularly one hitting 15%, indicates strong cost control and efficient management across their entire network schedules, maintenance, personnel.
That does sound strong for this sector. Yeah. And the bottom line, net profit margin.
Finally, their profit margin stands at 10.62%. This is the net income generated per dollar of sales after all expenses, taxes, interest.
Over 10%.
Yes. It's a really solid percentage, suggesting SKYW is quite effective at converting its substantial revenue into bottom-line profit. Maybe even compared to many mainline carriers who often struggle to consistently hit double-digit net margins.
Okay, those profit margins sound quite robust, especially, as you say, for an industry known for tight margins and high operating costs. Speaks to the stability of their contract model, perhaps.
It certainly seems to contribute.
Now, what about how efficiently they're using their assets and capital, all those expensive planes, to generate these impressive profits? What do the return ratios tell us?
Exactly. That brings us to their return ratios, which give us deeper insight into that capital allocation efficiency. Their return on assets, ROA, is 5.77%.
How good is that?
Well, it indicates how well the company is using its assets, its planes, equipment, facilities to generate earnings. Given how capital-intensive airlines are, an ROA above 5% is generally considered respectable.
Okay. What about return on equity?
Then, return on equity, ROE, is 16.95%.
Merely 17%.
Yeah. This shows how much profit the company generates for each dollar of shareholders' equity. An ROE of nearly 17% is quite strong. It reflects robust returns for investors who have put their capital into the company.
And ROIC, return on invested capital.
Lastly, their return on invested capital, ROIC, is 8.78%. This measures the percentage return that a company makes from all capital that has been invested, whether it's debt or equity. So it indicates good overall capital deployment and productivity.
So putting it all together.
Well, these margins and return ratios, collectively, they really suggest a well-managed airline. One capable of generating significant profits from its operations and effectively using its capital. And that's particularly notable in this industry. These figures really stand out, signaling a company that seems to excel at operational execution within its niche.
Okay, so they're clearly efficient at turning revenue into profit and making good use of their investments. Now, this raises that important question. How does the market actually value these impressive profits and assets? What do the valuation multiples tell us?
That's where valuation multiples come in, and honestly, they provide a bit of a nuanced picture. SKYW has a trailing 12 months PE ratio, price to earnings, of 11.86.
Okay, pretty moderate PE.
Yeah. And its forward PE, based on expected future earnings, is 10.59.
Lower, suggesting expected growth.
That's usually the interpretation, yes.
Yeah.
The fact that the forward PE is lower often suggests that analysts and the market expect earnings growth in the near future, which technically should make the current valuation look more appealing.
Makes sense.
But perhaps the most fascinating aspect here, especially if you're a growth-oriented investor, is the PEG ratio. It's 0.77.
Under 1? That's generally seen as good, right?
Very much so. The PEG ratio divides the PE by the earnings growth rate. A PEG ratio under 1 often suggests that a stock might be undervalued relative to its expected earnings growth.
So you might be getting future growth at a reasonable price today.
Yeah, that's the idea. For a company showing such robust growth, like we'll get into, a PEG ratio under 1 is often considered a significant positive signal. It suggests the market might not yet be fully appreciating its forward momentum.
That sub-1 PEG ratio is definitely a bright spot, implying potential for upside if the market eventually re-rates it higher.
Yeah.
What about other common valuation multiples? How they stack up?
Good question, especially the enterprise value multiples given their debt structure.
Right.
Okay, looking at other multiples, we see a price to sales, PS, of 1.22, a price to book, PB, of 1.82, price to cash, PC, of 6.47, and price to free cash flow, PFCF, of 16.54.
And the EV multiples.
Right, for a capital-intensive business, these are very relevant. Their enterprise value to EBITDA is 6.86.
That seems reasonable for an airline.
It's generally considered quite reasonable, yeah. And the enterprise value to sales, EV sales, is 1.71.
So what's the takeaway from all these multiples?
Well, these ratios, particularly that relatively low PE and the sub-1 PEG, could indicate that the market isn't fully pricing in SkyWest's growth prospects. Or maybe they reflect inherent industry risks that just temper the valuation.
And what above?
Could be. However, that EBITDA of 6.86 is quite reasonable, as you said. It suggests its total value, including debt, is pretty well aligned with its operating profitability before non-cash expenses like depreciation.
So it implies they can handle the debt with their earnings.
It suggests that while the company carries debt, it is generating sufficient operating cash flow to support its overall enterprise value.
Okay, so a lot to unpack there. But the overall picture suggests a company generating solid profits that, by some metrics, might be trading at an attractive valuation, especially given its growth trajectory. What about the per-share data? Quick look there.
Sure. On a per-share basis, their earnings per share, EPS, over the trailing 12 months is $9.82.
Okay.
Their book value per share, that's the equity value per share, if assets were liquidated, liabilities paid, is $63.97. And they have $18.01 in cash per share.
So healthy underlying metrics supporting the stock price there too.
Seems that way. These figures just provide a more granular view for investors tracking performance on that per-share basis.
Okay. So the current financials look strong, valuation seems reasonable, maybe even attractive. But what about the momentum? Is SkyWest poised for continued growth, or are these recent numbers maybe a peak?
Well, the growth figures certainly paint an interesting picture of sustained momentum, actually. Let's start with earnings growth, EPS.
Okay.
This year, SkyWest has seen very strong EPS growth, 29.22%.
Nearly 30% growth this year. Wow.
Yeah. Looking ahead, EPS is forecasted to grow by 9.57% next year. So still strong, but moderating a bit.
And longer term, say, next 5 years.
The projection is an impressive 15.43% annually over the next 5 years.
Double-digit growth sustained.
That's the forecast. It suggests consistent double-digit growth potential over the medium term, which is obviously a powerful indicator for investors looking beyond just the next quarter.
And looking back a bit further, how has their EPS performed in recent history? Does it show an acceleration?
It does. The past performance shows a significant acceleration. EPS grew by a huge 52.26% over the past 3 years.
52%.
Though interestingly, it was a more modest 3.26% over the past 5 years.
So the last 3 years have been exceptional.
Exactly. It highlights a significant acceleration recently, likely tied to, the robust post-pandemic recovery in air travel demand, but also probably coupled with successful operational improvements and maybe favorable terms on those contracts.
Makes sense. What about the really recent growth, year over year, quarter over quarter?
Even more striking, their EPS year over year on a trailing 12-month basis was an impressive 131.25%.
Whoa, doubled and then some.
And quarter over quarter, it grew by 59.44%. The expectation for next quarter's EPS is around $2.50.
Those year-over-year and quarter-over-quarter jumps are truly outstanding. It suggests they're really capitalizing on market conditions and their operational leverage.
It certainly seems so.
And what about their ability to beat analyst expectations? Did they surprise the market in their recent earnings announcement?
They did. Notably, SKYW topped estimates in their Q2 2025 earnings. They delivered an EPS surprise of 23.51%, beating expectations by almost a quarter.
It's a big beat.
And a sales surprise of 5.70%. These consistent beats aren't just good news, they indicate really robust earnings momentum.
Yeah, it suggests management is executing really well.
Right. The huge year-over-year and quarter-over-quarter growth, combined with exceeding analyst expectations, suggests significant operational leverage and strong demand for their services. These trends, coupled with those longer-term projections, they point to a potentially sustainable growth path.
So maybe not just a flash in the pan.
It indicates the recent performance might be more than that, maybe a reflection of underlying business strength.
That's incredibly positive news for anyone looking at growth. But earnings growth often needs sales growth to back it up. What's the story with their revenue expansion? Does it support these impressive earnings figures?
Good point. And yes, sales growth is indeed strong and seems to directly support the earnings expansion we just discussed. Sales grew by 9.14% over the past 3 years and 3.49% over the past 5 years. So again, you see that recent acceleration.
Right. And year over year, quarter over quarter on sales.
Sales year over year on a TTM basis were up 20.45%, and quarter over quarter sales were up 19.39%.
Also very strong recent growth on the top line.
Yes. These recent higher growth rates in both sales and EPS indicate that the company is effectively increasing its top line, likely through strong demand for regional air service and converting that revenue into higher profits through efficient operations.
That's the sweet spot, isn't it? Growing sales and growing margins.
It's a sign of a very healthy and expanding business, demonstrating both top-line strength and bottom-line discipline.
Okay. Now, given all this talk of profit and growth, does SkyWest reward its shareholders with a dividend? Or are they putting all that cash back into the business?
Good question. And it's worth noting that SKYW does not currently pay a dividend. Their payout ratio is 0.00%.
Zero payout.
Right. This typically means the company is reinvesting all its earnings back into the business, probably for growth initiatives.
Which aligns with the growth rates we're seeing.
Exactly. It aligns perfectly with its reported strong sales and EPS growth rates. In a capital-intensive industry like aviation, reinvesting profits into things like fleet modernization, new aircraft orders, operational efficiencies, that can often yield higher long-term returns for shareholders than immediate dividend payouts.
So, management thinks the best use of cash is growth.
It suggests management believes the best return for shareholders right now is through compounding that growth rather than immediate cash payouts.
Okay, growth is great, and reinvestment certainly makes sense for a growth-oriented company. But a strong company also needs a solid financial foundation, a strong balance sheet. How does SkyWest look there?
Yeah, in terms of its ability to meet its obligations both short-term and long-term, this is crucial for assessing resilience, especially in a cyclical industry. Okay, let's look at liquidity and solvency, key indicators of financial health. First, liquidity ratios measure a company's ability to cover its short-term liabilities, its bills coming due soon.
Right.
The current ratio for SkyWest is 0.73, under 1.0.
Yes.
This means SkyWest has $0.73 in current assets for every $1 in current liabilities. The quick ratio, which is a more conservative measure because it excludes inventory, is 0.63.
Okay, for a learner, those numbers might initially seem a bit low, maybe even worrying. Conventional wisdom often suggests a current ratio above 1.0, maybe even 1.5, is ideal. Is that a concern here?
Or is there an industry-specific nuance we should consider?
Yeah.
That's a very astute observation, and it raises a really important point about industry-specific norms versus generalized rules of thumb. For a learner, you're right. These ratios might indeed seem low compared to other sectors.
Right.
However, in the airline industry, remember, companies often receive payments for tickets months in advance of actually flying the passenger.
The unearned revenue thing.
Well, exactly. This unearned revenue is recorded as a current liability on their balance sheet. So while it appears as a liability, it doesn't represent an immediate cash outflow. In fact, it's cash that has already been received for future services.
So it inflates current liabilities without being a near-term cash drain.
Precisely. This unique characteristic means airlines often have robust cash inflows from operations, even with seemingly low current ratios. So it doesn't necessarily indicate financial distress. What's crucial to look at alongside this is cash flow from operations,
Which we saw evidence of with their robust earnings.
Exactly. So it's a prime example of why you can't just apply a generic rule to every industry. Understanding the underlying business model is absolutely paramount.
That provides excellent context. It truly is a prime example of why a one-size-fits-all financial metric can be misleading. But what about their long-term ability to meet obligations? Solvency. How are those ratios looking, especially regarding debt?
Solvency ratios indicate a company's ability to meet its long-term debt obligations. SkyWest's debt-to-equity ratio is 1.00.
1-to-1. Dollar of debt for every dollar of equity.
Correct. When we look specifically at long-term debt to equity, it's a bit lower, 0.80.
How does that stack up for an airline?
Well, given that airlines are extremely asset-intensive businesses, often relying on significant financing for aircraft. A debt-to-equity ratio of 1.00 or 0.80 for long-term debt can generally be considered manageable within the industry.
Especially when you consider.
Especially when you pair it with that healthy enterprise value to EBITDA ratio of 6.86 we talked about earlier.
Right, connecting the dots.
Yeah. That EBITDA ratio suggests the company can service its debt from its earnings before interest, taxes, depreciation, and amortization. So while they definitely carry debt, it appears to be within a manageable range for their industry. It aligns with their capital requirements for fleet expansion and modernization, and they seem to have a healthy capacity to manage that debt load through their operational cash flows.
Okay, so overall, the balance sheet seems broadly in line with what you'd expect for a company in this sector, and they appear to have the capacity to manage their debt. Now, let's move beyond the spreadsheets, beyond the balance sheets. What can we learn from the actions of those closest to the company, its executives and directors?
Right, insider activity. It can sometimes offer unique insights into management's perception of the company's value, though you always have to interpret it carefully.
Always with a grain of salt. So what do we see here?
Well, we already know that insiders own a relatively small slice, just 2.15% of the shares. What's particularly fascinating, maybe even a little concerning, is that insider transactions show a net negative of 14.79% over the trailing 12 months.
Net negative, meaning significantly more selling than buying by insider.
That's correct, a consistent trend of net selling.
Okay, the market often views insider selling with skepticism, maybe even alarm, right? Especially when it coincides with such strong stock performance and those bullish analyst views we'll get to. How much weight should a listener put on this?
What are the various interpretations of this consistent pattern?
Yeah.
That's a crucial question, and it's where the nuance truly matters. The data we have reveals a pretty consistent pattern of selling by multiple key executives and directors over the last 12 months or so.
Like who? And how much?
Well, the sources detail sales by the CEO, the CFO, the Chief Commercial Officer, the Chief Accounting Officer, the EVP of Operations, and a couple of directors. We're talking multiple transactions, often significant amounts, hundreds of thousands or even millions of dollars worth of stock per transaction. The total value sold across these insiders over the period is well over $20 million.
Wow. Okay, that's not insignificant.
Not at all. And it's happening at generally rising price points as the stock has performed well.
So interpretation, profit-taking, or something else?
Well, on one hand, it could simply be prudent profit-taking or a move towards diversification. These individuals often receive a significant portion of their compensation in stock or stock options. And selling some shares is a natural part of managing personal finances and diversifying their own investment portfolios, particularly after a stock has seen the kind of massive multi-year gains Skywest has. It's not uncommon, even expected, to see executives cash out a portion of their vested equity.
Right.
However, the sheer volume, the consistency of the pattern, and the fact that it involves multiple key figures across the executive suite, well, it could hint at a collective internal view. Maybe perception from insiders that the stock's price, after its huge run, might be getting a bit rich, or at least that its near-term growth potential might be leveling off from their perspective.
The perspective of those with the most intimate knowledge of the company.
Exactly. So it adds a subtle cautionary note that, sophisticated investors would likely weigh heavily against the otherwise bullish analyst sentiment we'll discuss.
So it's a piece of the puzzle, not the whole picture, but definitely a piece that warrants careful consideration.
Precisely. Don't jump to conclusions, but definitely keep it in mind as a potentially subtle signal.
Got it. Now, beyond individual transactions, what about the company's engagement with the broader political and regulatory landscape? Do they engage in lobbying?
They do.
And if so, what are the specific issues they focus on, and why is that important for an airline like SkyWest?
Yes, SkyWest has a consistent and pretty dedicated lobbying effort, it seems. They've consistently spent $50,000 quarterly on corporate lobbying. There was one instance of $30,000 in July 2023, but mostly it's that $50K per quarter rhythm.
Okay, so a regular budgeted item.
Seems like it. A regular dedicated effort rather than just sporadic engagement. And the issues they lobby on are very consistent. Aviation, airlines, airports, and budget appropriations.
Makes sense. So what does that tell us?
Well, this ongoing lobbying effort really highlights the company's active engagement with government policy. In a highly regulated and capital-intensive industry like aviation, influencing budget and appropriation decisions is crucial.
For things like subsidies or infrastructure.
Exactly. Potential subsidies, favorable infrastructure development, think airport improvements, air traffic control modernization, or just ensuring conducive operating conditions regarding things like pilot training rules, environmental regulations, or safety standards.
So it's proactive management of their external environment.
Pretty much. It's part of how the company manages its external environment and seeks to protect or enhance its business interests within that regulatory framework. They're trying to proactively shape the very rules they operate under.
Which sounds like a strategic investment to mitigate regulatory risks and maybe unlock growth opportunities.
That's a good way to look at it, yeah.
Okay. So they're actively working to shape the environment they operate in, which makes perfect sense for such a regulated industry, and it shows some long-term strategic planning. Now, shifting gears a bit, what are the market analysts saying about SkyWest? And what significant events or news catalysts have impacted the company recently? This gives us more of a forward-looking perspective.
All right, what's the current buzz?
Well, analyst sentiment is generally quite positive for SkyWest, which definitely aligns with the strong financial performance we've been observing.
Okay, how positive?
The consensus recommendation for SKYW is 1.20. On a scale where 1 is strong buy and 5 is strong sell, 1.20 is very strongly skewed towards buy or strong buy.
So analysts really like the stock right now.
It appears so. Furthermore, the average target price set by these analysts is $131.60.
Which is above the current price we mentioned earlier.
Right, indicating potential upside from the current price, suggesting they believe the stock still has more room to grow based on their analysis.
That's a very strong endorsement from the analyst community. Have we seen any notable upgrades or changes in analyst ratings over time? Does it show a trend?
We have, actually. There's been a remarkably consistent series of upgrades from reputable firms over the past couple of years. It really reflects increasing confidence as SkyWest's performance has improved.
Can you give us a few examples? Sure. Most recently, July 1st, 2025, Evercore ISI upgraded them from inline, basically neutral, to outperform, setting a $120 target.
Okay.
Before that, April 8th, 2025, Goldman Sachs upgraded from neutral to buy with a $117 target.
Another big name.
Yep. Go back to November 2024, TD Cowen reiterated a buy rating and raised their target significantly from $95 to $120.
Okay, seeing a pattern here.
Definitely. Earlier in 2024, February, TD Cowen had already upgraded them from market perform to outperform. And back in 2023, we saw upgrades from Raymond James and Deutsche Bank, moving from holds or market performs up to buys or outperforms. Even an upgrade from underperform by Raymond James early in 2023.
Wow, so a steady stream of upgrades and increasing price targets.
Exactly. This consistent progression over the past couple of years reflects that growing analyst confidence in the company's prospects and performance. It suggests analysts believe the company is executing well, is on a positive trend, and that the stock has more room to run.
They likely recognize the stability and profitability of that contract flying model we discussed.
That's probably a big part of it, yes. They're seeing the execution and the financial results that back it up.
Okay, so the analysts are largely bullish, and they've been becoming more so over time, validating the company's strategy. Now, beyond analyst reports, what are the recent news headlines that have shaped the narrative around SkyWest? Any major announcements or events?
Yeah. These news items provide really tangible context to all the financial data we've been discussing. They offer both positive catalysts and potential headwinds.
Okay, let's start with the positive.
First and foremost, a significant positive catalyst. On July 24, 2025, SkyWest announced strong Q2 2025 earnings and revenues that topped analyst estimates. And importantly, they announced a profit for the quarter.
Right. We saw the surprise percentages earlier. That reinforces the good numbers.
Absolutely. It reinforces the profitability and growth figures we've already highlighted, showing the company is consistently delivering on its financial promises, beating expectations.
That's great news, clearly validating their financial performance and operational efficiency. But what about potential headwinds or risks that have emerged in the news? Anything concerning?
Indeed. And this is a critical point for you, the listener, to note. There was a Reuters headline from July 31st, 2025, stating, FAA fails to resolve persistent issues with SkyWest maintenance, audit says.
Ooh, FAA and maintenance issues. That sounds serious.
It's definitely not a minor issue in the airline industry. While the financial results are strong, regulatory scrutiny regarding maintenance is a significant operational risk. It could have serious future implications.
Like what?
Well, it's something any industry would want to keep a very close eye on. It could potentially lead to fines, maybe operational restrictions, certainly increased maintenance costs to satisfy the FAA, or even reputational damage if it's not adequately addressed. It speaks directly to the stringent safety requirements in aviation and the direct oversight by the Federal Aviation Administration.
Okay, that's a significant operational concern that definitely needs attention, given the absolute paramount importance of safety in aviation. A definite counterpoint to the strong financials.
A very important counterpoint, yes.
Now, on a more positive strategic note, what about their fleet and sustainability efforts? Anything in the news about investments in future operations?
Yes, on the strategic front, there's been clear news around fleet modernization and sustainability, which is crucial for long-term efficiency and competitiveness in this business.
Like what?
On July 21st, 2025, it was reported that SkyWest finalized a new engine deal with the explicit goal stated as reducing its carbon footprint.
Okay, interesting.
This was followed up by a Zacks article on July 10th stating that GE Aerospace secured a deal from SkyWest to supply CF-34 engines. Now, these aren't just about going green, though that's part of it.
It's about efficiency too, right? Fuel costs.
Exactly. New, more efficient engines directly translate to lower fuel consumption and reduced operating costs over the lifespan of the aircraft. That's huge for an airline.
And any new planes coming?
Yes. Back on June 18th, 2025, Business Wire reported that SkyWest ordered 60 new Embraer E175 aircraft. These are popular, efficient regional jets.
So significant investment in modernizing the fleet.
Definitely. These new engine deals and aircraft orders are strategic investments for fleet modernization and sustainability. They impact long-term operational costs, efficiency, reliability, and competitiveness by ensuring they have a modern, cost-effective fleet for their regional partners.
It probably positions them well for any future environmental regulations, too.
That's likely part of the calculus as well, yes.
Okay, so a complex mix here. Strong financial results, strategic fleet investments aimed at efficiency and sustainability, but also this notable regulatory challenge from the FAA on maintenance. That gives us a really comprehensive and quite nuanced view.
It's rarely all sunshine or all clouds, is it?
Never. So to tie it all together then, what does this all mean when we pull it together? We've covered a lot of ground: financials, insiders, analysts, news, painting a full picture of SkyWest Inc.
Okay, connecting it all to the bigger picture. SkyWest Inc. presents as a financially robust regional airline. No doubt about that based on the numbers. It has shown impressive growth and stock performance over the past few years.
Right.
It's a company that seems to have effectively navigated the complexities of the airline industry, particularly in the post-pandemic environment, really leveraging that unique contract flying model we discussed.
Okay, let's quickly summarize the key strengths that have really emerged from this deep dive. Those clear indicators of a high-performing company.
Sure. Several significant strengths stand out. First, those strong profitability margins, gross, operating net particularly strong for an airline, indicating highly efficient operations and effective cost management, likely helped by those fixed-fee contracts.
What else?
Second, the company's earnings and sales growth rates are robust, very strong recently, and analysts are forecasting continued, sustainable double-digit earnings growth into the medium term.
Growth is definitely a theme.
Third, its valuation multiples, especially that compelling PEG ratio under 1.0, suggest it could be undervalued relative to its growth potential. That's a powerful signal for growth investors, potentially.
And fourth.
Finally, that very high institutional ownership, over 91%, indicates significant market confidence from professional money managers. It implies a belief in its long-term stability and strategy.
So profitability, growth, potentially attractive valuation, and institutional backing.
Those factors collectively paint a picture of a well-run, growth-oriented company that appears to have mastered its niche in the regional airline space.
Okay, so a lot of green lights and compelling financial performance. But what about the areas that warrant closer attention? The potential yellow or even red flags for our listener that could introduce risk or challenges down the road.
Right. The flip side, while the overall picture is strong, there are indeed areas to watch closely. The balance sheet liquidity ratios, current and quick, while arguably typical for the industry due to unearned revenue.
They still look low on paper.
They do. And while maybe not a distress signal given the nature of their revenue, it's something worth keeping in mind. They rely on consistent cash flow, and you need to understand the industry specifics.
Okay. What's more significant?
More significantly, I'd say, is that consistent pattern of insider selling, millions of dollars across multiple key executives. While it could be just diversification,
That raises questions.
it does. It's a data point that warrants ongoing attention. It's always worth asking why those closest to the company are consistently divesting shares, especially after such a strong stock run. It hints, maybe subtly, at an internal view that the stock might be fully valued, or near it. It's a cautionary note against the very bullish analyst sentiment.
A definite point of tension there. And the biggest risk?
Most critically, I think, is that FAA audit regarding persistent maintenance issues. That represents a significant potential operational risk. This is not a minor footnote in the airline industry.
It needs to be monitored very closely.
Absolutely. It could lead to fines, operational restrictions, higher compliance costs, maybe reputational damage if it's not adequately and publicly addressed. It's a direct challenge to their operational execution.